Hello everybody, and a very warm welcome to the first A.R.D. Consultancy Webinar of 2021 with me, Andrew Dawkins, and
myself, Rachel Blackhall.
It's lovely to have you all with us. We hope you had a very good Christmas and New Year. Seems like ages ago, but it's lovely to have you aboard today.
Yes, Happy New Year everybody. Thank you for joining us. So the agenda for today, we have, I'll run through what's happening at A.R.D. Consultancy since we're back now. Over to Andrew for a 2020 investment review. And then he'll carry on with what to look forward to in 2021 with his comments and predictions on the market.
Oh, I'm doing two things back to back.
You are, yes. I'm having a break today. Then I'll take over and we will look at, we just thought we'd pick one of our investment funds today to have a look into it a little bit more detail. So today we'll be looking at the Stewart Investors Asia Pacific Leaders Sustainable Fund. So we'll have a little bit of a look at the market and some of the top holdings in that particular fund, and then round off with our usual question and answers, if there is any.
Fantastic. There's the usual thing then, the question and answers. Put in your questions as we go along.
Yes. So slightly new system today, but just type them in as we go along and we'll pick them up at the end. So what's happening at A.R.D. Consultancy? First and foremost, we are still here to assist our clients, but following the latest government guidance, we're still not allowed to conduct any meetings in the office or in cafes and restaurants. We were trying to do for a little while towards the end of the year there, but since they're all closed, then everything is just carrying on over Zoom or telephone.
You're not going to go on about Zoom again, are you?
Well, just a little bit. I know that I've harped on about this a few times, but last year we discovered Zoom and it really has been so helpful to us in the way that we can carry on doing our jobs here in the office. So until we can meet you all again in person, it really is the next best thing if you want to see Andrew's smiley face.
Yeah, who wouldn't?
We've been kept busy, especially in the run up to the Christmas break. We completed our portfolio reviews and rebalance. So thank you all for watching those videos and responding to us. Next up, we have tax year end in our sights. So we'll be here before we know it, and we're going to be looking at making effective use of unused ISA allowance and pension allowances before the 5th of April. Which brings me nicely on to, if anybody is considering doing this, then please act sooner rather than later. Some of the investment providers are working on reduced staffing structures, so there could be slight delays in the processing side of things. Hopefully not too long, but it would just be good to get any transactions placed well in advance so that it's not sort of crunch time up to the last minute. And on that note, any of our clients who have assets on the Old Mutual Wealth platform, you might already be aware, I think we've sent out a mailing and they've also issued their own correspondence directly. They are going to be upgrading their platform to a new trading system. It'll just really enhance their offering and reduce the need for paperwork, which is always good, especially at the moment. This upgrade does mean, though, that there's going to be a blackout for a couple of weeks while they implement the new system. During this period, it's likely to be towards the end of February. So as soon as we have exact dates, we will be communicating that with you all. But towards the end of February, the system will go down for 2 weeks and we won't be able to add funds or withdraw funds. So just bringing us back to the end of the tax year, if you are looking to do anything, please do it sooner rather than later so that we can factor that in.
There's no action that any clients need to take, though, for Old Mutual, is there, in terms of correspondence?
No, there's not at all. So anything that's been issued is just for your information. Everything will move over to the new system without any client involvement. So it'll all be back up and running, hopefully in March. Same with the client website. The valuations and things will just be on hold while the system is down for that 2-week period. But after that, just dial back into your own client website and you'll be able to get valuations as normal.
The funds aren't just resting in your bank account, though, meantime.
I'm a blackout period myself as well. Just take 2-week holiday. Not at all. No, everything's just been moved over. So if any clients do want to do anything during that period, we can still try and get the ball rolling. It just won't be picked up until the system is back up and running. So it's just to make you all aware of that. And I think that's really all from me. There's not really a great deal else that we can report. We're still in lockdown, so we're just carrying on as best we can.
Good.
Anything you want to add?
No, I think you've covered everything, haven't you?
Good. So now, over to you for the 2020 review.
2020 review. Wow, well, what a year 2020 was. And, yeah, crikey, we're through it. Anyway, that's the main thing. So hopefully everybody's fit and healthy, and those that love are as well. So looking back, it's been a very interesting time here in the investment world, and probably actually one of the most dramatic years we've experienced. So at the end of 2019, most of these experts, and these experts are just as daft as you or I are, they were predicting that 2020 was going to be a bumpy year for most of the asset classes throughout the world. And I think by the time we got to the first or the second week in March, we would doubt that very much, with all the asset classes throughout the world suffering dramatically. And in fact, we saw the biggest downturn in markets in such a short time since 1987. So how did 2020 work for us then? So we, as you know, most of you will have assets invested in one of our 5 portfolios, and the portfolios are designed for long-term growth. We don't design a portfolio to make money over a short period of time, whether it's a few months or even a year or two. It's all designed to give us money over the longer period. And by taking more of a long-term approach, it enables us then to actually make more return by taking less risk, which seems a bit crazy, but many of you have seen that over the last few years. So all the portfolios performed exactly the way we'd have expected them to perform, given the dramatic effects of COVID-19. So the less equity exposure, those funds fell in value, but didn't fall as much as the portfolios with the higher equity exposure. And then when we got towards the end of the year, those portfolios with the higher equity portfolio picked up in excess of the portfolios with less equity. And we'll look at a video just at the end of the presentation here, which will give us an idea of that. Looking at the sectors in particular, so the UK equities, well, last year the FTSE 100 and also the FTSE All Share Index, they fell by around about 14%. So 14% depreciation in share value, excluding dividends, over 2020. Leading the fall were the 2 major UK oil companies, BP and Shell, and their share price fell by over 40%. Banks were forced by governments to suspend dividend payments and were therefore unable to provide the usual level of security we'd expect in such a situation. We know that hoteliers, airlines were very, very badly affected, share prices plummeting to new record lows, and that has continued for most of the year. Big constituents of the UK 100 index, the biggest companies listed by public ownership in the UK. Mining companies were also badly affected, as there was less demand for commodities throughout the world, with economies slowing. Our own UK equity fund, the one that we use for the majority of investments, fell, but that fell by just over 1%. So 1% as against the fall in the major indexes of around about 14%. So the funds actually perform exactly as we would want. When the index goes up in value, we want to benefit from that growth. But when the indexes fall in value, we want to be protected if we can. And it's by avoiding companies such as banks. We still don't have any faith in those. We haven't held banking stock for over 10 years. And also avoiding those cyclical things like the hoteliers and the airlines, because although they make money, when times are good, they make a good amount of return, but when times are less so, they don't make as much. And you can liken that to your own circumstances, probably. Many people not going on holiday abroad next year, and are we going to get abroad this year? We don't know. And so that really comes to the point that you want to invest in companies that make money, or assets that make money, whether times are good or bad. So in terms of where we were for this year in terms of good news, or 2020 rather, then 2 of the companies that did very well that we hold, Spirax Sarco, which is an English manufacturing company that do a lot of exporting, their share price grew by over 21%. And here in Scotland, the Weir Group, with its headquarters in Glasgow, did even better, and they posted a share increase of over 28%. On the smaller side of companies, so that the companies that are outside the top 100 or even outside the top 250, and that includes the AIM market, the very small companies in terms of market size, they had a really, really good year. So 2020 was great for smaller companies with growth of over 15% positive growth in our smaller UK equities fund. And as we've said many times in the past, smaller equity companies tend to do very badly going into a recession, but then come out of it the other side very, very strongly, because they get squeezed for capital investment going in where people try and avoid, or liquidity becomes an issue. And then when they sort of pick up, because they're smaller, they're more nimble on their feet, they're able to speed out or adapt. So it's performed exactly the way we would have expected. Big falls on the way in, big rises on the way out. Europe, the Eurozone, well, that had a very mixed year last year because it's such a divergent range of countries and economies. The stocks Europe 600 index, which measures funnily enough, family numbers.
No way.
600 companies, and that index fell by over 10%. So that's the major companies in Europe falling by around about 10%. However, the fund that we use within our portfolio and for many of our investments posted an 11% growth, 11% positive growth for 2020. Major contributions came from Novo Nordisk, a Danish pharma company, Dassault Systems, a French software producer, and also
what's this one?
Well, the next one coming, Biomuriu, a Spanish, it's actually a French pharma company. So those companies posted good returns, and once again, if you know where to look, there are returns of positive nature in the market at all time periods. But US equities then, so moving over to the US, biggest economy as we know by far in the world. What a year that was for the big tech companies, even though some of them actually aren't necessarily tech stock. But the NASDAQ index, so a lot of these companies here are listed, they reached all-time high last year. The star of the show was Tesla with 700% share growth, 700% share growth. Amazing for an electric car manufacturer.
Yeah.
Incredible. Anyway, Apple up 41%, Microsoft 28%, Amazon 43%, and Apple, which as you know owns Google, at 23% growth. All those funds held within our major US fund that we use within our portfolio. And speaking of that fund, our US fund delivered over 16% positive growth in 2020. Property. So here we're talking about UK and worldwide commercial property, so not your homes and your domestic property. A very tough year because going into the pandemic situation, then there was a big the challenge we had was actually getting properties valued, because the surveyors that go out and value properties, they were in lockdown as well. And then throughout the year, many people were worrying, well, actually, the tenants, would they actually have the funds to be able to pay their rents each month? Would they be looking to renegotiate leases, etc.? And this caused the UK property funds to be suspended. Indeed, some of the funds are still suspended, some of the big funds, because of valuation worries. The portfolio itself, so our UK property fund, then that posted a loss of 3% over the year. But partway through the year, you'll remember we switched away from UK property because of the dealing challenges, and we moved to worldwide property, and that posted a loss for 2020 of -4%. At the Far East, well, I think Rachel's going to cover that in a minute, so we'll leave that to her because I've got to draw a breath. Fixed income. A posh word for a couple of words for debt. So lending money to UK companies, worldwide companies, and also governments. And because of the level of quantitative easing or pumping money that governments and central banks have done throughout the world, this allows more capital, which means that companies and governments have been able to borrow more and more money at cheaper and cheaper interest rates. So this pumping money in is designed to encourage companies and governments to spend money on projects that create wealth and to build employment and preserve jobs and the economy. So it's the difficulty we've got as an investment company is when all this money is pumped into the cycle, it sort of reduces interest rates and returns because the situation is that there's too much supply of money. And so therefore companies are able to renegotiate their rate of interest for lower debt levels. And similarly, UK and other governments are able to fund huge amounts of debt because they pay less for it. Even though we have those situations, the UK Gilt Fund, so UK government borrowing fund that we use for our clients, it grew by 14% in 2020. Quite extraordinary. So overall, what we'll do now is we'll put a video on while I can have a cup of tea. If you'd like to just adjust, though, on your devices, if you could unmute, so you may see in a minute the little mute sign. If you could click on that just so you can hear some beautiful music. And we'll put this on and we'll be back with you very soon.
Yeah, so the video itself is around 3 minutes long. We thought it was good, although investing is a long-term approach, since 2020 has been a year unlike any other, we thought we would just home in and show exactly how our portfolios have fared over this 1 year period. So I'll pop this on now for you.
And welcome back. There we are. What are we going to do next, Rachel?
So we have what to look forward to in 2021. So back to you.
Okay, and this is on the financial planning side rather than, well, I think we all hope
in general.
Get out and have a drink and meet family and friends and One of the things that we get used to. But,
keep it on topic then.
We'll have to, won't we? I think that's it. So if we start here with UK equities, and I think when we look towards what's going to happen here, a lot of it is going to depend on the pandemic and how quickly the virus is brought under control. It's fairly obvious that the sectors that are going to struggle until that is fixed are the likes of the hotels, the airlines, the retailers, anything to do with that leisure spending, the spending that's been building up. And therefore, we still want to remain away from these companies. There's a lot of portfolios out there that have likes of Ryanair stock or even EasyJet stock within the portfolio, or one of the big UK hotel companies. And the difficulty there is that, as we said a few minutes ago, although when the bounce back comes, hopefully these companies will be still trading, the share price will increase probably by more than the average. The challenge we have, though, is longer term, these companies make money when times are good, and when they're less good, they don't quite make as much. So therefore, we stay away from them. Interestingly, Shell is now back in our top 10 holdings across most of the portfolios, and that was out of the portfolio. It was the first time I've ever known it to be outside the top 10 in all the 120 years I've been doing this. So the companies that are going to do well so far, then the commodity companies, so the mining stocks, as the world starts to open up again, then the mines are being mined, stuff's been taken out of the mines and being used and exported and all the rest of it. The household staples such as within our portfolio, Unilever, Reckitt, Diageo should all do well. Again, good demand for consumer basics. We haven't held, as we said, we haven't held banks for over 10 years, and we can't see any reason for holding them just now because of the pressure on their bottom lines. Negative interest rates don't help at all, and so forth. We'll stay well away from banking stock at the moment. There's a few good news items with Nissan last week saying not only was it maintaining its production in Sunderland, but it was actually increasing. Batteries are now going to be produced there, so that's a great success story. And also we saw that Unilever last year, but they centred their headquarters back in London as opposed to the Netherlands. Again, a sort of a good news story for many of the Brexit doubters. So now that Brexit's finished, that what we're seeing is that a lot of the so-called experts, just as daft as you or I remember, so-called experts are saying that the UK is picking up a lot of investment money, and that will continue throughout this year as it's been underperforming the UK economy for a number of years, and therefore growth is expected to be probably in the UK the highest through the developing world over the next year or so. So as more money comes into portfolios, with the Brexit uncertainty largely behind us, then the market's going to overperform. However, you see, it's been wise after the event, and ever since the Brexit referendum result was announced, we were great fans of it because we think it's very, very good for what we do, which is making money for people. I think the BBC thought that the world was going to end, and funnily enough, it didn't. So Brexit is good for what we do. So it is certainly very, very helpful, and that's behind us now. So again, it looks like the market is set for further growth for this year. US equities, well, Democratic win, the presidential election, and also then the Democrats in charge of both houses in the US gives, normally when the Democrats win, the markets react fairly badly because they're generally seen as the party of taxation and less for private enterprise. But this time, I think it's been the opposite because of the fact that they're saying, well, Trump has done so much damage with world alliances and organizations over his time in office, and therefore it needs to be a period of conciliation. So already we've seen that Biden has re-engaged with the world, committing the US to the Paris Climate Accord again. So I think the potential is for the US to do very, very well again because of the stimulus package that hopefully this time will be brought through. Trump failed in his plans to bring in his $1 trillion expenditure, as he did on many things, and the chances of actually getting the US economy pumped full of cash again is very, very high, and the Federal Reserve is continuing to pump massive amounts of money into the US. The big challenge with that is obviously COVID, and then trade tensions with the US and China in particular, because Biden is not doesn't seem to be wanting to take a less harsh stance on China than Trump was. So it looks like that's the one that we do need solving, getting some world trade sort of back on the agenda. The euro area, well, the euro is such a desperate area. Many analysts. Thank you very much. Easy for me to say. Dear, are predicting the eurozone will probably underperform in terms of world markets. The ECB deposit rate, so when you lend money out, deposit money within the ECB, the eurozone rate is still negative at minus 0.5%. So if you actually deposit money with the ECB, you give them 0.5% of your money each year for them to have the pleasure of holding it. Indeed, it's almost the same rate for lending money to the German government, and these rates are likely perhaps to go even lower. Interestingly, Italy is one of the few major European economies with a positive lending rate to the government, and its 10-year rate is just over 0.61% a year. So who'd have thought that years ago Italy pays just 0.6 or 1% in debt. Asia, well, we're very, very positive with Asia. Rachel will tell you why in a few minutes. We increased our exposure to Asia a number of years ago, and sometimes when we do this, it's not to make returns immediately or for the next year or two. It's to take more of a long-term view, and that certainly now is paying off. Whereas I think 2 years ago, when people were saying, well, why have you increased Asia exposure? It's not done as well as Europe or the US. We go, yeah, but we don't do it for a 1 year period if you look further out. So now when we look at the performance charts, Asia's now coming into its own. Rachel will tell you more in a second about that. Fixed interest, well, as we said, the world is awash with cash. It looks like that shows no signs of diminishing, and therefore the outlook for fixed interest is rather gloomy for the next year or two until inflation starts to pick up. And I don't think many people are expecting inflation to pick up this year or even perhaps into next year. So for those clients in the more defensive portfolios with higher fixed interest exposure, which is our defensive and cautious portfolio, it may be an idea just to revisit that when you're having your review, because we may want to just go up the risk level by 1 to reduce the fixed interest return. Certainly, though, the last 15, 16 years have been fantastic periods of growth for fixed interest. Many people would say they're huge returns that we've seen from fixed interest. Commercial property, so the Worldwide Property Fund is a very good property fund we're now in. It just gives us that wee bit of diversity. We don't hold a huge amount of stock here. Some sectors will be badly affected, retail, and other sectors will do very well, storage and high quality office accommodation based in the major cities around the world. So generally, the outlook is actually probably one of the best outlooks we've seen in a very long time. Brexit's been done, as we said. We've got a new president in America. The big thing is obviously the COVID-19, and we want that under control. That's really going to once we can see that that's taking effect and people are getting vaccinated and the virus is diminishing, then that will give us the real growth push that we need. Interestingly, though, and it will probably be the same for you at home, that many of our clients and many people throughout the world have actually seen their cash reserves increasing as there's been nothing to spend money on. And in March of 2020, Britain paid off more debt than ever, and there was more debt sort of paid back anytime since 2013. And it's estimated that the UK in the first lockdown saved around about 17.5 billion pounds in money that would have otherwise been spent. So we can see that once we get longer into when the pandemic comes under control, there's all this pent-up demand, which then people with money will be saying, well, I'm going to go on a holiday, I'll go on another holiday, and perhaps even another holiday. I'll spend more money, I'll go to the restaurants, I'll treat my financial advisor to his favorite bottle of champagne. I'll do all sorts of wonderful things with all this cash we're accumulating. And that's going to be the same throughout the world, that there's this huge amount of cash there, not debt, but cash that's going to be used to stimulate economies throughout the world. So this year looks a really, really good one, as long as COVID enables us to do that. The other thing, the final point just from me, and then I'll shut up, is we definitely advise that perhaps clients, especially after seeing that video, should always be mindful of, are we taking the right level of risk? So when you have your reviews, we go through the risk reward chart, and you can see then that we keep this under regular review. But in our level of risk that we talk about, it's a lot less risky than stockbroker risk, or it's a lot less risky than putting all your money on one share or one stock. The risk is really that the investments will fall. That's the guarantee. The investments will fall, but they won't fall to zero. That's the big thing. So once we get the time, once you give the investments time to do their stuff, there is really no risk involved in what we do. There really isn't. So if you could spread the word, family, friends, even people you don't like, tell them to take the money out of cash and do something with it, because it's great for the economy. So ethically, what you're doing, being invested, is very, very good, because that's creating jobs, it's paying taxes, and it's helping the world recover and grow. So it's very, very good what all our clients do with their money. So
that's why we build these portfolios, is to diversify and spread your money across all these different areas of the world that Andrew's just mentioned. And that also spreads the risk. So like you're saying, it does reduce the level of risk you're taking in total, while hopefully doing some good and making some money along the way.
Can't be bad.
Right, are you finished, Andrew?
Whew,
you sure?
I need to lie down now.
Okay, so I'll just take this one then, the Asian market. Although this webinar, we're going to look at one of our particular funds within that market that is in our portfolios. Before we do that, I'm going to have a look at the sector as a whole. So the Far East, or as it's also known, the Asia Pacific sector, has held up extremely well in 2020. They've been the first in and first out of this pandemic. They've certainly not suffered as badly as some of the other areas of the world. Could be because of the growing population, growing incomes, increased consumer demand, but certainly they have seen a strong bounce back. China's economy has rebounded extremely well, while many other areas of the world were still struggling, still shutting down. They're certainly on the way up. The particular funds that we use in our portfolios itself grew by 26% in 2020, which...
How much?
Yes, 26% just last year, this fund alone. That makes it the best performing fund in our portfolios, and the best performing sector, definitely. So very positive. So as Andrew mentioned, increasing our exposure to this area a while ago really is paying dividends. It's paid off. It's sadly, the pandemic obviously has affected things, but it's not all been bad news. And to see that level of growth really is positive. The particular fund itself that we have been supporters of for quite some time is Stewart Investors Asia Pacific Leaders Sustainable Fund. So we've been invested in this fund for years now, and over time, the recent change is the added sustainability. So the fund itself is now classed as sustainable, which we've spoken about before in previous webinars. So I'm not going to reiterate too much about it. But what this really means is that the investment criteria will set out the companies that are considered for inclusion. Any companies that the fund managers look to acquire and include within this fund must meet certain criteria. That's set out as they must contribute to sustainable development in the countries in which they operate. It'll include things like their social usefulness, environmental impacts and efficiency, and responsible business practices, which I think are all certainly good things to be doing, and certainly a good thing to have within your portfolio, knowing that these companies are making money whilst doing good in the world. So we're going to have a look at a few of the top 10 holdings within this particular fund and see exactly what it is that they do. First up, we have Hoya. They are the largest holding within the fund. Hoya is a Japanese company who manufacture optical products such as glasses and contact lenses. And while I don't have any particularly exciting stories to tell you on this one, what I can say is that they have weathered the storm of 2020 well. They saw their share price increase Unsurprisingly, Hoya contribute to, and I quote, the realisation of harmony between people, society and nature. No. Andrew's sniggering already, which fits well with the sustainable nature of this fund. They support education, provide glasses to people in developing countries. They've reduced CO2 emissions and set targets to reduce this further in 2021 and beyond. So, don't want to say boring, but I mean, everybody who needs glasses will still need glasses regardless if there's a pandemic going on or not. But yeah, they're doing well and carry on. Good work. Unicharm, next one of Andrew's favourites here. So any of you who have had a review recently with Andrew will no doubt have heard him mention this particular holding. A company based in Japan, and they are the world leading manufacturer of, Andrew?
Oh, specialist products.
Adult nappies. So we shouldn't laugh, but we shouldn't. They also produce baby products, feminine care, pet food, household cleaning and healthcare products. But one particular product that's been highly sought after this year,
adult nappies.
Not quite as much, even more so than that, is face masks. We've all bought them ourselves, and Unicharm have been working round the clock to fulfill orders. To give you an idea, Unicharm and other Japanese companies increased their domestic production of surgical grade masks to 15 million, and that's up from 550,000 before the pandemic. So massive, massive increase there. Trying to keep up with demand has been difficult, and as supplies run low, Unicharm have put plans in place to start producing 1 million medical grade masks per month by spring. So they certainly see the need for this across the world, and while they up production, continue to be doing well.
Can I just ask Rachel, what's that on the plate? What are those two items?
I couldn't guess. I wasn't expecting that question.
Okay, well, we'll find out for next time.
I'll send Unicharm a message. And next up, we have Tata Consultancy Services. And I've had to pause while I say that there. I said earlier in the week, Tata. And Andrew said, no, it's not that. But I do think that's a better way to pronounce it. Sounds better in my opinion. So a large company, you may already recognise the name, founded in 1968, headquartered in Mumbai. But today we're only going to look at one division of this company, and that is the Consultancy Services arm. They provide a wide range of information technology related products and services. As Andrew already mentioned, IT in the last year has really took off. They also operate in lots of other sectors: banking, retail, financial services, media, lots more. But as every industry is facing unprecedented, sorry to say that, threats and opportunities, it's predicted that 50% or more of the global economy will be digitised by 2020, which means that organisations really need to figure out how to survive and grow in the digital world. And Tata have been well positioned to ride this out. Only this week, they became the world's largest IT company by market cap. So in the process, it also became India's most valuable company. But it really is a great success story. And hopefully, it will continue to provide our clients with more investment growth going forward. What we have next is a graph showing how this particular fund has compared to the benchmark. And you'll see here it's going back over the longer term, but as we focus on this webinar, more so over just the last year. And the reason we picked this particular fund to talk about today is that you can see from 2020, it really has massively outperformed the benchmark. Anything to add, Andrew?
No, it's a really good quality fund, and it's delivering what we would hope to achieve from all our funds, which is outperforming the average, delivering greater growth. And when times are good, then we can see that. When times are less good, then we would hope it would fall by less. And it shows the added value that the fund managers bring to this. And that's what we try to achieve with all our investment funds. It's to give that added value. And this certainly has. and outstanding performance. And one of the reasons why a number of years ago we actually increased our exposure to Asia and the Far East, because it's probably one of the most exciting areas in the world today to be looking for growth.
Yes, so what we'll do is we will just pause for a moment, see if we have any questions that we can cover off now. If you hold on and bear with us, thank you.
And welcome back. And we've had a question in from Ian from Wishaw, and Ian's asking that Scottish independence seems to be rearing its head yet again, and what are our views going forward regarding portfolios, etc., or financial planning. It's one of those areas that is well, reasons I suppose to be a little bit worried. If there's a change of view here, and if Scotland got independence, then obviously it can change the rules, the way financial advice is governed. We look at what reliefs are available, what tax issues are there, and how we can maximise growth and reduce taxes. A change of government, a change of nationality, I think, a change of rules and regulations could affect that, and probably would. However, it looks like Scotland's trouble would then be trying to align itself with the EU again. And in terms of EU legislation, we're already very familiar with that in terms of financial planning and financial services. So it really, if the rules weren't changed that much, it wouldn't have much effect. Financial markets as well, because of the fact that Scotland, and there's no disrespect here, is a small part of the UK in terms of the economy and the size, it probably wouldn't have much difference in terms of the UK stock market or share prices. The thing that it may find difficult is then the government debt in Scotland. It could become a lot more expensive, a lot more, well, perhaps up a few notches, because of the fact that it'd be a new country that doesn't have an experience of repaying debt directly. So it may have some technical issues, but in terms of financial planning, I think the big one would be if there were any fundamental changes, such as pensions contributions or ISAs or inheritance tax, capital gains tax, those sort of things. So yes, we'll stay tuned, but I think the most disappointing thing is that we don't want yet more referendums, because it's such a divisive thing, as we've seen with Brexit and the referendum before. I think it's a time to come together and try and do the very best we can and support one another rather than be divisive. So anyway, that's just my personal view.
Great. Another question in which was very, very similar to that about the Indie ref and what effect it would have on investments, but I think you've sort of covered that. I was going to take the next question, but it's a personal one. So Andrew, Colin's asking, what is your favourite champers?
Oh, well, Colin, as it's you've got a very, very deep pockets, we know that. So yeah, I'll go for a nice crew if you won't mind, please. Thank you very much. Vintage, of course. So 66 is one of my favourite years. Yeah, I'll just leave it at the front door because we can't accept visitors. So thank you very much. We got a question here from Susan. And Susan's asking, with the amount of debt that's being built up at the moment by the UK government, is it likely that taxes will increase? There needs to be a repayment of the debt, and that I think goes without saying. What will happen, though, is once the consumer expenditure starts to increase and this pent-up demand that we see, it will bring into the exchequer a huge amount of revenue from excise duty, VAT, and other tax raising products and services, etc. And it's likely that the level of debt, I think I'm quite optimistic that the level of debt will fall quite dramatically, because a lot of these industry experts have been wrong so many times in the past when they were talking about the level of debt not being paid back for many years. In 2008, they talked to us about the UK economy being desperate if we didn't join the euro and various other bits and pieces like that. So I think actually revenue taxes in themselves, actually, if you increase taxes, you reduce revenue because people are disincentivized to actually spend money or work harder or longer. So the idea is many countries that have lower levels of tax than the UK actually see per head higher expenditure, higher revenue coming into the exchequer, because they're encouraging people to work more, spend less in tax, and that then encourages them to spend more. So I think that they may play about with the taxes. They're talking about capital gains tax being overhauled. Some of these taxes here in the UK as well, they do need to be overhauled because they're so complex. They really are. And it's almost impossible to keep up to date with them. So it does need an overhaul, I think, the UK tax. I don't think tax rates will increase as dramatically as many people are fearing, just because of the level of demand in the UK. There's so much money about not being spent at the moment. So I think that will come to our aid later on. And we'll probably look back and go, well, some of these comments that are made by these so-called experts are doom and gloom. And remember what they were saying about Brexit, about the world ending, and it just simply hasn't. So I'm a lot more optimistic.
Good. Right, well, I think that's really us for today. We will schedule in another webinar next month. We'll have a think about what to discuss then. As always, if there's anything in particular that anybody wants to hear about, then please let us know. We will do our best to accommodate that. And thank you all for listening. I'll just round off again by saying, tax year end, if anybody wants to do anything, please get in touch soon. We'll be doing all we can at our end to get in touch with any clients that we think can still make use of ISA allowances and things. But as Andrew mentioned, many people are building up money in cash accounts. So if you want to do anything with that, then please let us know.
Lovely, yes. Thank you very much for your time today. It's been super doing the first webinar 2021. We look forward to many more throughout the year.
Back at it. Thank you again.